Every long-term investment rests on certain foundations, assumptions about income, costs, and stability that guide our decisions. For years, buy-to-let seemed to offer a firm ground, steady rents, manageable borrowing, and familiar rules. Many investors built their plans on that basis. But foundations shift. Higher interest rates, tighter regulation, slower rental growth have all altered the structure of buy-to-let. What once felt straightforward now requires far closer attention. At the same time, diversified portfolios have been gaining ground. They're drawn broader sources of return, avoid many of the practical pressures landlords now face. For investors considering the next steps, the contrast between these approaches is becoming increasingly clear. To guide us through these shifts, I'm joined by Rosie Bullard, who's a partner and portfolio manager at James Hambro Partners, someone who really helps investors understand what's supporting their wealth and how to navigate changing conditions with clarity and confidence. When you look at the buy-to-let landscape today, what are the key structural changes that stand out compared to, say, a decade ago?
Two main differences fall into tax and regulation. Tax. We know the tax environment has changed significantly against landlords. Even most recently, we've had a change in income tax associated with property rental income that will come in a couple of years' time. And then on the regulation side, a lot of regulation is now in favour of the renters rather than the landlords, which makes it much more challenging for landlords to have as much flexibility as they did historically around tenants and property upkeep.
And with regards to investors, what assumptions do investors often carry from the earlier era of buy-to-let, and how do those assumptions shape their expectations now, do you think?
I think there's an assumption that you're always going to make a capital return on property. And if we look back in previous decades, investing into property has resulted in significant capital growth. Think about how much a property in London cost in the 1960s versus today. And alongside that, you have had rental income, and in many periods, rising rental income. It was only a few years ago that rental income went up significantly in the post-COVID era. So that assumption that you're going to get capital growth and going to get income, I think, still sits in investors' minds. But really, actually, if we look in recent years, particularly around capital growth, I think we need to materially change those assumptions. We're in a very different rate environment. We are in a very different liquidity environment. And therefore, when investors are looking at what they think the total return is going to be on a property, you can see the rental income, but you can't necessarily guarantee the capital growth. And then if we think about the after-tax returns as well, that environment is very different now. Stamp duty is higher than it used to be. Property income taxes are higher than they used to be. The ability to offset costs has changed as well. So the absolute key is thinking about your after-tax yield on the property, as well as how much the property might cost you to upkeep over the period of ownership. And the cost of borrowing as well. If you decide to have a property portfolio with leverage, that rate of interest that you were paying in 2021 versus today is probably very different. And therefore, your property assets have to sweat much harder to create an after-interest cost return.
So in contrast, how do diversified portfolios generate returns, and what makes their risk-reward balance different from property?
So in many respects, there are lots of similarities between property and portfolios. Within portfolios, your total return is capital growth, as you may or may not get within a property or property portfolio. And then you have the income return. The difference being the income return from a property is your rental income. The income return in a portfolio could be dividends from companies. It could be coupons from bonds. It could be interest.
So many different areas for income as regards just to capital gains.
And those income streams can change over time as well. So if we think about dividends, for example, companies tend to raise their dividends above the rate of inflation each year. And so dividends can increase over time, whereas a coupon from a bond, for example, is fixed. And then the interest rate that you earn on cash is linked to UK base rates. So in terms of your view of income being the most important element of total return, you're likely to get more visibility of income from a property portfolio over a 12-month period because you know exactly what the rent is going to be. Whereas depending on how your portfolio changes, which asset you hold, your income can differ within an invested portfolio.
So when people think about building resilience into their long-term wealth, how do you help them compare these two approaches without framing it as kind of a strict either or, giving them a definite choice?
In terms of thinking about resilience, we often think about how can we preserve the real value of capital? How can we produce inflation-beating returns? And there are many ways to do that. You can do that within an investment portfolios. Equities, for example, have on an historic basis provided a very attractive source of long-term real returns. Property on an historic basis in certain areas has done that too, but there is a bit of a question mark as to whether that will happen on a long-term basis, particularly after tax. So when we look and think about resilience within a client's assets, it's what is their asset base? What's their income source? What is their expenditure? Do they in particular have enough income to be able to service their expenditure, and that income being that after-tax income? So resilience within a client's wealth is being able to achieve the goals that they want to achieve, but also making sure that we've got diversification. So some clients feel much more comfortable having an invested portfolio that's highly liquid and then having a property portfolio which is much more tangible. The other big factor around thinking about resilience in asset base is clients often want to know how much their asset base is worth. Your property value doesn't change day to day. Now, in the future, with technology changes and the way that properties might end up being traded on a segmented basis in the future, that can change. But at the moment, you don't get your property valued every day, but you can have a valuation of your portfolio every day. And some people feel really uncomfortable with the fact that they can see a fluctuation in their net worth, in their portfolio values, depending on what's going on in equity and bond markets. And that feeds into the liquidity point in terms of your asset base as well. If you want to have flexibility within your asset base, holding a series of properties is challenging because you can't sell them. Whereas a liquid equity portfolio can be liquidated and the money is sent back to you in but a few days. And you likely know what the tax consequences are of doing that. You likely know what you think the approximate value of that return of capital will be. And the fact that you can do it within a matter of days rather than going through the process of selling a portfolio, which we all know is not straightforward.
What's the most important thing to be thinking about when choosing between property and a diversified portfolio?
In some respects, some of the decisions are very similar. So we think about from an investment portfolio, you want to choose the right investment house. Who do you want to work with? Very similar for a property as well. What area of the country, of the world, do you want to have your properties? Then you want to choose what type of portfolio do you want? Do you want a portfolio with an equity bias? Do you like bonds? Are you someone that really likes absolute return funds and hedge funds or commodities? So you're thinking about the type of portfolio. Similarly with properties, you're thinking about the type of property do you want? Do you want flats? Do you want a house? Do you want a semi-detached house? Do you want a multiple occupancy property? So that's similar in terms of the initial decisions. And then as you start to take a step forward, you want to think about what are the costs associated with doing that. Now, in the UK, stamp duty is significant, particularly on larger properties, whereas setting up an investment portfolio, there might be some small transaction costs associated with investing that money, but it's not going to be nearly as material as stamp duty on that initial purchase. So we have to think about initial costs. Then we get to the point in saying, okay, well, now that I hold this asset, what do I need to do as an individual, as an owner of the property or properties or the owner of the investment portfolio? You might choose with an investment portfolio to have it managed on an advisory basis. So you have a very interactive relationship with your investment manager, a lot of time put into it. Or you might decide to have a discretionary portfolio. So you set the parameters with the investment manager as to what you want to achieve, what you do and don't want to invest into, and then you let the fund manager get on and do that on your behalf. Whereas, as we well know, with a property, if you decide not to have a managing agent, there's a lot of work to be done on it. So we've got your initial work to be done. Maybe the house needs to be done up or at the very least furnished for renters. Then are you going to be the one sorting out the boiler when it goes wrong or there's a leak in the roof? So that amount of time that you want to commit can be very different between having a property and having an investment portfolio. So in terms of the different tax treatments, it is material. And if we think about total returns from a property, most likely much of your return is going to come from rental income, which you will be taxed at a much higher rate than in a portfolio where much of the return will come from capital gains tax. There's a material difference between income tax and capital gains tax in the UK, and indeed the income tax on property rental income is rising from 2027. So your after-tax return is the absolute key to think about in terms of the impact that has on your total growth within a portfolio. And indeed, then on top of which, you need to think about, well, actually, if I come to the point of wanting to either liquidate my investment portfolio, go back to cash, liquidate my property portfolio and go back to cash, what are the implications of that? So if I want to sell a property, I need to find the buyer. That takes time. I've got transaction costs associated with that, legal fees, for example, and then I've got to pay capital gains tax on any gains that I've made. Within a within an investment portfolio, you need to think about what's the capital gains tax implications of liquidating my portfolio, and indeed, are there any exit charges relating to the end of the life of the asset? There are some investment houses that will charge you to leave the product unless you have been in there for X number of years. The other factor to think about is ISAs. ISAs are a very tax-efficient way of saving and investing, and you can't wrap your property into an ISA.
That's very kind of you to take the time to have a chat with us today. You've answered a lot of questions that will give people a lot of food for thought in this market.
Indeed. Well, I'm glad it was helpful. And of course, any other questions, do let me know.
Lovely job. All right, Rosie, thank you very much.
Thanks, Rory.
Cheers. Take care.
Bye.
Bye-bye.